Private equity is often portrayed as an innovation in investment, a cycle of buying companies, improving them, and selling for a profit. But investigators have uncovered a deeper, more unsettling reality. Private equity is not just about investment. It is a restructuring force that shapes economies, replaces leadership, controls debt, absorbs entire industries, and ultimately determines which companies survive. It is a shadow world of silent, pervasive influence. Analysts first became suspicious when they noticed that companies acquired by private equity firms often exhibited the exact same pattern: identical restructuring methods, identical asset liquidations, identical layoffs, identical debt structures, and identical exit strategies. These were different companies in different industries, yet they all followed the same blueprint. It became clear that private equity was operating with a coordinated precision that went far beyond simple market logic. Behind nearly every major private equity deal, there is a network of offshore funds. These funds are designed to conceal critical information: the identity of investors, the structure of the fund, the distribution of profits, the origins of capital, and the tax minimization strategies being employed. These offshore hubs operate as complex master feeder structures, layered partnerships, and opaque trust systems. Money moves in complete silence through jurisdictions engineered for secrecy. The core of private equity's power is the leveraged payout. In these deals, debt, not cash, is used to buy the company. The company itself becomes the collateral. Its assets are then sold off to repay the loans. Profits flow upward to the private equity firm, while the risk stays with the company and its workers. The more debt that is applied, the more control the private equity firm gains. Companies are not acquired. They are captured. Private equity doesn't just buy individual companies, it absorbs entire industries. Through a series of coordinated acquisitions, these firms gain control over vast sectors of the economy: healthcare, housing, media, retail, food production, manufacturing, logistics, and energy. When multiple private equity firms target the same sector, competition disappears. Industry consolidation is no longer a natural market process. It becomes a form of elite engineering. After a buyout is complete, private equity deploys specialized operational transformation teams. These teams have one singular mission: maximize cash extraction. They oversee aggressive cost reductions, asset liquidations, labor restructuring, real estate sales, supply chain redesigns, and debt refinancing. These teams operate like corporate special forces, precise, silent, and ruthlessly effective. Private equity thrives not on ownership, but on debt. By controlling a company's debt, they control everything: company decisions, leadership choices, growth strategy, financial reporting, and market behavior. This control extends to sector-wide leverage. Debt becomes a tool of influence. Leverage becomes a mechanism of power. This entire model is protected by a political and legal shield. Private equity enjoys specific regulatory advantages, crafted through powerful and elite lobbying networks. These advantages include tax exemptions, capital gains loopholes, disclosure exemptions, favorable bankruptcy laws, and privileged access to pension funds. These benefits were not accidental. They were engineered to protect and sustain the private equity model. The law itself became a tool. Behind the financial jargon and corporate speak, Private equity restructuring reshapes human lives. Workers experience sudden layoffs, wage reductions, benefit cuts, and shorter contracts. Local facilities are closed, and operations are relocated or outsourced. The human impact is deliberately hidden beneath layers of financial reporting. The public sees a factory closure. The private equity firm sees a profit extraction. The exit strategy follows a predictable pattern. Private equity firms exit their investments through three primary channels: selling the company to another private equity fund, selling it to a large corporation, or taking the company public through an IPO. In every scenario, the profits are secured long before the company's long-term stability is confirmed. Success isn't measured by a company's viability, but only by the return on capital. Investigators who have tried to map this network of influence have faced a wall of institutional obstacles: sealed filings, redacted documents, confidential fund structures, untraceable ownership chains, and shell companies that are created and dissolved with blinding speed. Any inquiry is met with immediate and aggressive legal pushback. The shadow world of private equity remains opaque by design. Why are elite groups so intensely focused on expanding the reach of private equity? Because it provides them with control without visibility, influence without ownership, transparency, and direct access to critical industries. It gives them the ability to impact national economies, strategic leverage through debt, and a system for multi-layered, long-term wealth extraction. Private equity is not just an investment strategy. It is a silent architecture of global power. This leads us to a final set of questions. Is private equity a financial tool, or is it a hidden economic empire? Are companies failing naturally, or are they being systematically restructured for extraction? Is global consolidation an organic market trend, or is it orchestrated by networks that reshape industries behind the scenes? The truth isn't found in annual reports. It's found in the debt structures that bind entire sectors to silent, elite control. If you're ready to uncover the next layer of global influence, subscribe to the Hidden Codex and tell us what you believe private equity truly represents.